Before 2026, setting up an automated recurring payment in India meant navigating a fragmented system. The specific rules depended entirely on the financial instrument used. On April 21, 2026, the Reserve Bank of India consolidated years of scattered circulars into a single unified framework for all digital mandates. This document establishes that definitive baseline. Section 11 of the framework systematically wipes the slate clean, repealing 7 years of iterative circulars issued between 2019 and 2024. It collapses cards, prepaid payment instruments, and the unified payments interface into a single operational standard. To understand how this operates in practice, we need to deconstruct the framework into its 3 technical pillars: precise authentication triggers, hard-coded threshold limits, and mandatory asynchronous notification loops. The 2026 framework functions as a definitive state machine specification for all recurring payments in India. The first pillar tightens the application of the additional factor of authentication, or AFA. Authentication is no longer applied as a blanket rule across every payment flow. Instead, it acts as a precision gatekeeper, deployed exclusively during specific lifecycle state changes. This flowchart shows the baseline structure of an e-mandate. The lifecycle is broken down into 4 distinct nodes: initialization, modification, first transaction, and revocation. The first mandatory trigger is strict. A one-time registration process requires successful AFA validation before the mandate can even exist. If a user alters the contract, modifying the amount or extending the validity period, the system demands a fresh AFA validation. Even terminating the agreement requires verification. Issuers must use AFA to successfully process a mandate withdrawal or revocation. Section 5 outlines one logical exception. If the first transaction is processed concurrently with registration, both AFA validations can be combined into a single prompt. Authentication functions as a strict cryptographic seal, invoked only when the fundamental parameters of the automated contract are altered. The second pillar establishes hard-coded transaction limits and velocity checks. To maintain systemic efficiency, routine recurring transactions must be processed automatically, without AFA intervention, up to a specific financial limit. This diagram shows the standard payment pipeline, which caps out exactly at 15,000 rupees per transaction. Any standard recurring transaction attempting to exceed that 15,000 rupee mark hits an absolute wall, immediately triggering a mandatory AFA prompt. However, the framework provides an exception for high-trust asset classes. For these specific categories, the frictionless limit is dramatically expanded to 1 lakh rupees. Section 8 lists exactly 3 permitted categories in this high-value tier: insurance premiums, mutual fund subscriptions, and credit card bill payments. The regulatory logic isolates these asset classes because they are systemic to individual financial health and present a structurally lower risk for consumer fraud. This dual threshold system allows institutional capital to flow automatically while keeping everyday retail payment risk capped strictly at 15K. The third pillar focuses on mandatory customer communication loops. Automated recurring payments historically create friction because they often execute without a direct warning, leaving the user with an unexpected debit. The RBI addresses this by enforcing a strict 24-hour pre-transaction notification requirement. This timeline visualizes an executing mandate. The critical intervention point sits exactly here, at the T-24 node. At least 24 hours prior to the actual debit, the issuer must send a payload containing the merchant's name, transaction amount, date and time, and the mandate reference number. This alert is not a passive receipt. It operates as an active, asynchronous control mechanism. The user is presented with an actionable choice. Issuers must provide an active opt-out facility, allowing users to intercept and cancel specific transactions within that 24-hour window, an action securely validated by AFA. This technically shifts transaction authorization latency back to the user without breaking the automated flow of the backend. There are exact operational carve-outs where this T24 pre-notification loop is explicitly waived. The first major exception covers auto-replenishment balances for highway FASTag systems, where execution speed is the priority. The second applies to the National Common Mobility Card, which relies on real-time execution at physical transit gates. Beyond notifications, Section 10 introduces operational restrictions, dictating that no charges can be levied on a customer for using the e-mandate facility. It also ensures continuity. Issuers are explicitly permitted to map existing e-mandates to newly reissued cards, preventing payment failures when a physical card expires. These specific carve-outs prove the RBI is prioritizing real-time systemic utility, like transit and highway flow, over absolute notification compliance. When evaluating the macroeconomic impact of the 2026 framework on fintech builders, the intent is clear. The framework shifts the burden of compliance away from the end user and embeds it entirely into the back-end system architecture. Section 9 legally maps existing consumer protections directly onto this new standard, strictly limiting customer liability for unauthorized recurring transactions. By combining precise authentication gates, dual risk pipelines, and asynchronous 24-hour control loops, the RBI has engineered a highly predictable environment. Consumers can now engage with automated payments knowing they operate under a zero-liability structure. But this creates a strict regulatory responsibility for payment system providers and acquirers. They must ensure every merchant they onboard natively complies with these exact threshold limits and notification APIs. Moving forward, every single automated recurring payment across India now executes smoothly within these rigorously standardized, predefined technical gates. The future of automated finance in India is unified, safely capped, and